So why was my phone ringing? My phone was ringing because of what happened. I call it the slow grind down in 2021. All right? So inflation started taking off. All right? How did they curb inflation? When they finally realized that we've got to do the Fed, when they finally realized that we've got to do something about this. They raised the interest rates. All right? The market cycle was in its late inning anyways. Normal market cycles last anywhere from 8 to 12 years. We were like in year 14 when this, back in 2022. It was far surpassed. Back in 2018, we entered a seller's market phase 2. And if you're familiar with this graph, this is how I teach market cycles. In 2018, we were in seller's market phase 2. So, you know, the best time to be in a market is right at the very bottom there at the buyer's market phase 2. That's where you've got very low risk, you've got a huge amount of appreciation, and you can one market and you can be done. If you get in late in a seller's market phase 2, the next seller's market phase 1, that's last year, the second half of the emerging phase, still a good time to be in the market, still a lot of opportunity, still a lot of money to be made. And that's what happened. A lot of people got in the market around 2017, 2018, 2019, and they started doing deals and they started making money. And you know, if you've ever seen me teach market cycles, I always say that emerging markets make sloppy investors. So you come, you get trained, you learn to be a conservative investor, like my mentor taught me. You work the Trinity. You know, the three ratios with the Trinity for us is a cash-on-cash return of 8+, a cash-on-cash return of 12+, a debt coverage ratio of 1.6, and a cap rate of 8+. So you go into deals very conservatively when you're starting out and do those ratios. Can you move them around a little bit? Can you buy deals with a smaller Trinity numbers? Yes, you can, but you do it after you get some experience, after you start building your real estate gut. I mean, if you really want to be safe, you go in with a Trinity, you go in with a momentum deal, the property starts to cash flow immediately, and you hit home runs on your first couple of deals. Well, people started looking. See, it's tougher to find deals in a seller's market stage 1 in the late stages and a seller's market phase 2. So people hit the Trinity, and maybe on their first deal or maybe their second deal, and that was okay, but then they started fudging those numbers because even though they kind of fudged them on the first time, it all worked out. And then when they got themselves into another deal and they went lower than the Trinity even farther, it still worked out. And then when on the next deal, when it was coming in, and I thought, wow, you know, I've got the Midas touch. Everything I touch turns to gold. They start becoming crazy investors. And that's why emerging markets make sloppy investors, especially in the late innings. So in 2018, I got out of the market. Not completely. Didn't stake a flag somewhere. It wasn't on a big buying spree. It was like, okay, so I feel this is the entry of the seller's market phase 2. Yes, there's still upside in the seller's market phase 2. There's still, look how much time that is, right? It lasted well, first, here's the big problem with the seller's market phase 2. It's high risk, all right? That market's going to roll over. You just don't know when. So in a seller's market phase 2, if you're not out of the market, you're going to get caught. So it could last from 2 to 3 years. 2 to 3 years while everybody else is out there buying and talking about how much money they're making, you're sitting on the sidelines because you want to be safe, because you preserved capital. You know, that's the number one investment rule. Preserve your capital. So the deals that we did, we still did deals, but we made sure those deals were going to be good. So we get into good deals. We did 1 or 2 deals a year. If that was it, I was happy. Fourth market cycle. I made the mistakes in the first cycle. I thought everything I touched turned to gold until that cycle changed. I was like, oh, damn. You know, those deals that we had during that first cycle, we had done approximately 32 deals, 32 complexes. We were closing a 1.5 complex a week. It was crazy. And things were going good. And all of a sudden, that market changed just like that. Nobody expected it. Market changes. And 4 of those deals were so difficult, looked like they were going to go upside down. We spent all of our time, 3 years, working on those deals to make sure we didn't lose anybody's capital, make sure that those deals went right. The other deals were going good, that by the time the market turned, we were so focused on these deals, we lost a lot of opportunity in the second cycle to make sure that the deals in the first cycle actually worked out. So I learned my lesson. We get this phrase in New England, you know, I'm a Boston boy. We got this phrase in New England that when you go through something like that, that sucks. and you don't want to do it again. So in the second market cycle, when I was recognizing that we're in a seller's market phase 2, that this market's turning over, it's like, I'm not doing it anymore. I'm either going to cash out or I'm going to keep my legacy properties. So we did that through the next couple of phases. So in this particular phase, we go to 2020, the market's still going up. We go to 2021, market's still going up. It's like, wow. But all of a sudden it peaks. Cover the screen, please. All of a sudden it peaks at 2022. And that's the top of the market. That's when the Fed decides that they're going to start taming inflation and start raising those interest rates. Like, all right, so the Fed starts raising the interest rates, and something that has never happened since I've been an investor, or at least was aware of, is that bridge loan financing became more attractive than Freddie Mac and Fannie Mae. It became cheaper to do those deals with that financing. So bridge loan financing is where you go when you have a deal that is below 85% occupancy. Freddie Mac and Fannie Mae won't do it until it gets to 85%. So you need to bridge that financing so you can get into the cheaper, more secure Freddie Mac, Fannie Mae financing. Bridge is usually like a point or two over Freddie Mac and Fannie Mae. It's somewhat painful. You factor it into the deal. The deal works with the bridge. Then you go in with the purpose of knowing that you're going to be going into Freddie Mac, Fannie Mae. So bridge loan financing, for the first time, the rates were below Freddie Mac and Fannie Mae. Never saw it before. All of a sudden, we had people sending us deals saying, hey, you want to sponsor this deal? We love sponsoring deals, by the way. I love sponsoring deals. If you get deals you want to have sponsored, please come to me. I'll do it with you, as long as it's a good deal and it works, and it's in a good market. If it's not a good deal and it doesn't work, there's this old Chinese saying that I learned when I was in the rock and roll band. I was in a rock and roll band from the time I was 16 to 24. So there was this place called Johnny Lee's. It was a Chinese restaurant. And all the band, they had bands there Friday and Saturday nights. And all the big bands in my area, the small local big bands, would play Johnny Lee's. And we would always go and check out the bands and sit there and drink all night and have a lot of fun. And Johnny Lee was a bartender. So we would say, Johnny, let us play, let us play. The name of the band was Flesh Picnic, by the way. And it means exactly what it sounds like, Flesh Picnic. So I said, Johnny, let us play, let us play. Let us play Friday night, let's play Saturday night. We're good, we're good. He says, finally, he relented. He says, okay. He says, you come on a Monday, you play. He says, you good, you play Friday. He says, you no good? Not the matcha you can do. Right? So that's my saying when everybody comes to me with a deal that doesn't work, right? This deal doesn't work. Not the matcha you can do. And it's true. So we had so many deals coming through, the last couple of years, our desk, and it was like, these guys are crazy. They're doing these deals with these numbers, and everything has to line up perfectly for this deal to work. And one of them was deals penciling out with bridge loan financing. What's the problem with bridge loan financing? It comes due. It's short term. It comes due 3 years later, 2, 3, 4 years later, and then you have to refinance it. So you're really playing Russian roulette with the interest rates. If rates remain the same, great. You just get yourself into a good deal. If rates go up, you get a problem. What happened? What happened? Rates went up. Rates went up. So, press the wrong button. Here's the other thing that people were doing. They were basing their returns off of a value add of increasing rents. So that was like like double trouble, because rents started becoming stagnant. Oh, and here's another thing that people were doing, is they were doing preferred returns that were cumulative. So the deals that I would see go past the desk, the deal structure would be a 7% preferred return cumulative. So the sponsor was saying, Mr. Investor, if we don't make this return, don't worry, because we'll make it up on the back end. It's cumulative. Well, that is a recipe for disaster. I mean, my philosophy has always been, and if you're a sponsor, you may lose some money to other investors because of this, but my thing is, hey, we're all in this deal together. We'll all make the money together on the back end. So, hey, it might be 6 months before we see a distribution. It might be a year before we see a distribution. It depends on the deal, the type of deal it is. But we're all in this together. So the cumulative returns, eventually what happens is when there's no cash flow on a property, okay, the investor doesn't get paid until the end of the deal. If the investor's not making money to the end of the deal, if they make any money, that's a really shaky deal because the person running the deal isn't making any money. So what are they more focused on? Deals that are making money. Yeah. So you got to be, as an investor, you've got to be really careful of the deal structure that you're getting into. It may look good up front for you as an investor, but it may not be good for you in the long run because of the structure of the deal. So just be aware of that. And as a syndicator of deals, set yourself up to win. You know, the whole idea is it's like our tenants. I always say our tenants are our gold. And our investors are our gold as well. First, set it up so the investors win and the investors get a great return. But also set it up that you win as well. If you're going to get into a deal where it's not a win-win, where you're both going to win, you know, you may get an acquisition fee up front and that's it. That's not a good deal. It's not a good deal for you. It's not a good deal for your investors.